Good morning, sir. We're here to discuss the private equity modeling test. The members of this group are Christine Salazar, Christian Salazares, and Sean Gabriel Lau. So first, we're gonna talk about the cash flow assumptions. So for total square meters, it's at 68. And then for analysis, it's a date right now. For tenant, it started at January 4th, 2021 till January 4th of 2024, which is at 100,000 pesos rent per month. And then for February 4th of 2024 till January 4th of 2027, it increased for 25%, so it's at 125,000 pesos. And then for free rent, it's at 6 months. It started at June 4 of 2021 till December 4 of 2021. So for the tenant improvement, it's at 10,000 pesos. Operating expense ratio, it's at 10%. Reimbursement revenue from columns 0 to 36 will be at 10%. And from columns 37 to 72, it's at 14%. You will see that in the cash flow later. So for the capital reserves per month, it's at 15,000 pesos. We're now going to discuss the purchase, sales, and financing assumptions. Again, total square meters, it's at 68. Purchase price at 10 million. Closing costs, it's purchase price multiplied to 1%. Mortgage recording tax, it's the purchase financing multiplied to 1%. And then the total purchase price, it's just the sum of purchase price, closing costs, mortgage recording tax. And then for the financing, this is basically purchase price multiplied to 60% LTV. And then for monthly interest payment, this is the purchase financing multiplied to 5% cap rate divided by 12 since it's monthly. For equity in, this is basically purchase price subtracted to purchase financing. And then for refinance, NOI month 37 to 48, this is just the sum of the net operating income from months 37 to 48. For valuation end of year, we divided the NOI months of 37 to 48 to the cap rate of 5%. And then for refinancing proceeds, we multiplied the valuation end of year 3 to 60% LTV. And then for monthly interest payment, this is the refining proceeds multiplied to 5% cap rate divided by 12 since we're computing for the monthly. Cash out refinancing, we just followed the if computation in the video. And then next, NOI year 6 is basically the sum of the net operating income from months 60 to 71. Tapos sales price of year 5 is the NOI year 6 multiplied by the cap rate of 5%. Sales cost, it is the sales price and year 5 multiplied by 1%. Net sales proceeds is the sales price and year 5 subtracted by sales cost. And then for mortgage balance, we also followed the formula given in the video. We formatted the if. The 6% came from the no refinance, and then for the 18 million, it's with refinance. Next is the equity out. So we just subtracted the net sales proceeds by the mortgage balance. And then for investment structure, for our sponsor, it's at 15%. Investor is at 75%. Preferred return is at 18%. And then per month, we divided the per year to 12, which is at 1.5% per month.
Well, I'm going to discuss the cash flow, and we have two types of cash flow, one with refinance and one without. So for the first part of the cash flow, we identified the rental revenue, and the tenant pays us 100,000 pesos all the way until month 36. It increased by 25% on the 37th month all the way until the end of the year at the 72nd year. And next, we indicated free rent. Basically, this is a discounted or a benefit to the tenant. We gave them free rent for 6 months, starting at the fifth month all the way until the 11th month of on the first year. For our expense and reimbursement revenue, this is 10,000 pesos all the way until the 36th month, and it changed on the 37th month with 17,500 pesos until the 72nd month. In our effective gross revenue, we have 110,000, which is basically the sum of these three. Uh, it is the sum, so it's 110,000 from the first to the 36th, and it's 142,500 all the way until the 72nd month. For operating expense, it's 10,000. This is because of our we we multiplied the rental revenue by D20 of assumptions with it, which is the operating expense ratio. So it's 10,000 until the 36th month, and it's 12,500 all the way from the 37th to the 72nd. In our purchase financing, since we are doing refinancing, we only put 25,000 until the 36th month, and it doesn't count all the way until the end. Due to the refinancing, we put in 75,000 until the 72nd month, starting on the month 37. For debt services, it is 25,000 until the 36th and 75 until the last month. For cash flow after debt, it is basically we basically subtracted the net operating income to the debt services, and that's what we did all the way until the end. For the tenant improvements, we this is basically when the tenant would want to renovate their office or something, and they paid 10,000 at the start. For capital reserves, it is just 15,000 as indicated in our assumptions, all the way until the 72nd. Cash flow after debt service and capital cost. This is basically the subtract of the cash flow after debt, the tenant improvements, and the capital reserves. And that's what we did all the way until the end. Cash flow after capital costs. This is basically we subtracted the net operating income, the tenant improvements, and the capital reserves. For the cash flow with no refinance, the only difference is that we removed refinancing in this document, and we added 25,000 all the way until the 72nd month. And it really changed everything everything in the bottom here. In the purchase of sale, this is basically we took everything from the assumptions and the purchase price plus closing costs, which is the purchase price plus the closing cost, and the closing cost costs 100,000 and the purchase price is 10 million. For the cash flow after capital cost, this we basically copied what we had in with refinance. Cash flow after capital cost here. We copied all of these and put this in our purchase and sale document. And for our sale, we added this from here, the net sales proceeds. And at the end of the purchase and sale, we added everything. We had the sum of everything. Then we commuted for the IRR by putting IRR parentheses and all the values that is indicated in this row. So we have 2.15% per month and 29.03% per year. So just like what I said a while ago, purchase price plus closing costs, then net operating income in the first year is 500,000. And going in cap rate is 2,020%. For our equity in, this is what we identified in the assumptions. This is what we identified in D42, which is 4 million pesos. For cash flow after debt service and capital cost, we copied what it is in no refinance. So cash flow after debt, this is what we copied. And the next is cash out from refinancing. So since we don't have refinancing, I didn't add anything here. And for our equity out, this is what we identified here in our assumptions, which is 27.462 million pesos. Then just like what I did a while ago, I added everything in order to compute for the leverage deal of IRR, which is 3% per month and 47% per year. We have a net cash flow profit of 28.152 million pesos with an equity multiple of 8.04. And lastly, for our leverage analysis with refinancing, the only difference is that we took our cash flow after debt service from the document with refinancing, and then we added the cash out from refinancing of 12 million pesos, and our equity out would be 14.462 million. Then we added all of those in order to get the leverage deal and level of IRR, which is 4% per month or 66% per year. As you can see, we have generated lesser profit rather than with no refinancing, which is with 26.352 million pesos with an equity multiple of 7.59%, or 7.59.
For the investment structure, we have here 15% for sponsors and 75% investors. The preferred return is 18% per year. Divided by 12, we have here 1.5% per month. So we have here the month that is until 72 yan. 72. So the cash available for distribution is -4 na nakuha lang sa equity in na naging negative dahil sa purchase and sale, yung leverage analysis. So the first end of period balance, cash is computed as cash distributed times 15%, tapos follow lang siya. So we calculated the payment by cash distributed per month times 15%. Yung interest is EOP balance ng month times 2%. The principal is the amount that we borrowed and have to pay back. So it's payment minus interest. So the new EOP balance is old EOP plus the principal. So the EOP balance was said, this one. The EOP balance was said to be the beginning of balance, but the true beginning is when the interest is added. So if you add the EOP balance before tapos yung interest, yan na yung true beginning of period balance. So copy lang yan. So now we have the total available, payment, and overflow. So yung total available is the cash distributed times 15 and the payment is the payment amount na nakuha lang dito. So yung overflow, isusubtract lang yung dalawa na yan and we got 0. Same lang yung ginawa sa investor. Same lang yung ginawa namin dyan. So yung first EOP balance niya is negative 4M times 75%. Kasi yun yung sa investor side. Yan, follow lang siya. Tapos yung interest niya is EOP balance times 2% and the principal is yung sum lang nila. dalawa. So the new EOP balance is old EOP plus the principal. That is 2. So we also have here the total available payment and overflow. So yung total available, nakuha lang siya cash distributed ng month na yon times 75%. Tapos yung payment, copy lang sa payment amount ito. Tapos yung overflow, sinubtract lang yung dalawa na yun and we got 0 again.